Banker is once again teamed up with consultancy Brand Finance to rank the world's most valuable banking brands. We analyzed the ranking in our February edition cover story. And to take you through some of this year's most interesting results, I'm joined by Brian Caplen, editor of The Banker. Brian, thank you for joining me. So, another edition of The Banker's Top 500 Banking Brands. What are the key highlights?
Well, that's right. We've been running this ranking for more than a decade now, so we do have a big sort of body of data to pour on. But this year, there are three big things, really. One is the fact that the whole brand value overall has gone through $1 trillion. The second thing is that the Chinese banks have again improved and increased their strength in the ranking. And the third thing is continuing declines in European banks, especially German banks saw a 34% drop in brand value.
So let's dive in the Chinese story. For the first time, a Chinese bank is leading the ranking and has displaced Wells Fargo, the previous number one for the past 4 years. So ICBC is now the world's largest banking brand. What was behind this growth?
That's right. I mean, yeah, ICBC is now in number one slot. Wells Fargo obviously had some problems with the account opening scandal, so there was a bit of pressure on them. But generally speaking, I mean, we've seen Chinese banks growing with the Chinese economy, expanding overseas, and to be fair to themselves, doing a lot of work on their brand value in the domestic market, things like electronic banking and recruitment drives and community works, all things that soft things in some way, some of them hard things, but that elevate the brand value, and it does seem to be paying dividends for them.
So the emotional components of what constitutes a brand value. And this strategy clearly paid off because the total brand value rose by almost a third last year.
That's right, and you've now got 4 banks in the top 10, you've got 3 banks in the top 5, you've added some more banks to the total ranking, and almost of the total 45 banks in the ranking, Chinese banks, only 2 of them fell in brand value and all the others increased. So it's a pretty impressive performance.
And it is almost the entire opposite to what has happened in Europe.
Yeah, so I mean, the US is still, plodding ahead, right? So they're still pretty strong. But Europe was another story altogether. Most of the banks fell in value. UK banks as a group led the way, so they were down 16%. That was pretty disastrous, although the UK did hold on to 3rd place in the country ranking. Germany and Italy saw bigger declines, and so, I mean, Germany's banks were brought down 34%. A lot of that was due to declines in Deutsche Bank. And then you saw smaller declines in places like France and the Netherlands. So,
and of course Italy.
And Italy, yes. So a pretty negative outlook for European banks.
Now, you mentioned the US, of course, and the whole of the top 10 is an alternation of Chinese and US banks almost down to number 7. So US banks still very much strong. The US economy is also recovering. And perhaps we should also mention another story that also appears in our February edition, which is the one of initial thoughts of markets moving from bonds to equities.
That's right, yes. Our capital markets editor, Danielle Miles, has written a story about what's called the Great Rotation. And this is the idea that, as the economy turns, and you've seen a massive bull market, a sort of 20, 30-year bull market in bonds, and with interest rates rising and Trump coming into power, investors would sell bonds and buy equities. And indeed, we have seen big rises in the US stock market since Donald Trump's election. But what Danielle found, in fact, was that she thinks the Great Rotation is a bit of a myth, that what you have now is very big pools of investors, and there are bond investors and there are equity investors, and they tend to stick to their sector and they don't cross over as perhaps they did a generation ago. With retail investors, maybe they do. Maybe they sell their bonds and buy equities. But the big institutional investors in bonds, are going to stick with bonds, and they're going to be looking at the interest rate rises probably as an opportunity to get lock into some better yield going forward. And equity markets are going to look at stocks and how they're going to perform as the economy improves in the US. So we've sort of debunked the Great Rotation myth.
All right. Well, thank you for your comments, Brian. And for more on brands, rotations, and the rest of our geographical and markets coverage, stay on thebanker.com.